Recently, I've covered both the QYLD ETF and the NUSI ETF, which use option strategies to provide investors with high monthly dividends. However, there's one other ETF that I often see mentioned alongside these two, and that's the JP Morgan Equity Premium Income ETF, ticker JEPI, which I'll be referring to as JEPI in this video. On the surface, JEPI looks like a safe choice for monthly dividend income, with an annualized yield currently sitting at about 8%. When I took a closer look, I realized that the majority of that 8% yield comes from about 15% of the JEPI portfolio, which happens to be a pretty mysterious and complicated group of holdings. And the more I looked around for info on this part of the portfolio, I realized nobody is talking about it because 1, people either don't understand it or choose to ignore it, and 2, JP Morgan gives us very little information on it themselves. So in this video, we're breaking down the JEPI ETF and its strategy so that any potential or current investors out there have a full understanding of where their money is going. After doing a brief overview of the strategy and characteristics of the fund, we'll dive into JEPI's stock holdings, which make up about 80% of the portfolio. Then we'll get into the gritty details about ELNs, or equity-linked notes, which are the instruments that JEPI uses to produce the majority of its dividend yield. These make up just 15% of the portfolio, but they're really the defining characteristic of this fund and have some mysterious qualities that we need to take a look at. After understanding the overall strategy, we'll take a closer look at the dividend and consider what to expect from it in the future, specifically in regards to the reliability of the yield and its tax treatment. Finally, based on all of this information, we'll try to answer the question, should you invest in JEPI? So let's get started. As the name suggests, JEPI is a fund designed to deliver high income to investors without sacrificing the potential for capital appreciation. Specifically, the fund aims to provide a majority of the returns associated with the S&P 500, while also providing lower risk, lower volatility, and regular income. JEPI accomplishes this with two main components. The first is low volatility large cap stocks, most of which pay dividends. This strategy is fairly common, especially among standard dividend ETFs, and provides the low volatility aspect of the portfolio. However, this strategy doesn't even come close to fulfilling that 8% dividend yield, and that's where the second component comes in, which is the use of equity-linked notes, or ELNs. The fund also has a small portion of their holdings in a money market fund and S&P 500 futures contracts at about 2% each, but considering they're so minor, I won't be covering them here. Instead, we'll break down both of their larger positions further, starting with the simpler stock component. The first thing to understand about JEPI's stock portfolio is that it's actively managed. The team of advisors at JP Morgan will actively research and select stocks that they believe will have less volatility than the S&P 500. They will mostly be choosing stocks from within the S&P 500, although they do say that they may also include stocks outside of that index. They have a 3-step stock selection process, starting with research, during which they'll determine an estimated fair value of the stocks involved. Step 2 is ranking all of the stocks by valuation so that they can find the stocks that are considered to be most undervalued. Using this information, they'll buy and sell stocks from their portfolio as they deem appropriate. They also consider criteria like potential catalysts and the risks involved with each stock. Interestingly, even though this is an income-focused fund, it says they do not select stocks based on anticipated dividend distributions. To me, this means they'll probably look beyond high-yielding stocks simply because they'll pay a nice dividend, and instead focus on the research-driven criteria. So overall, JEPI uses a pretty standard value investing approach to build its stock portfolio. Because they're choosing stocks from the S&P 500, most of these are going to be large cap stocks, and they'll likely gravitate to the blue chip dividend stocks that exhibit low volatility and steady growth. At the time of writing, they hold 91 different stocks that make up about 82% of the portfolio. Most stocks are weighted between 0.5% and 1.5%, and you can see the top holdings are all pretty small positions. When comparing the sector breakdown to the S&P 500 via the SPY ETF, we can see that JEPI has lower exposure to the more volatile tech sector and more heavily favors sectors like utilities and industrials, which should provide lower volatility and steady dividends. To quickly touch on active management, although I normally take the opposite stance, I don't see it to be a huge threat with this fund. With over 90 holdings fairly evenly weighted, I think they've diversified away a good amount of risk while maintaining decent exposure to the S&P 500. My biggest fear with active management is picking the wrong stocks, but with a portfolio like this, I don't think we'd be able to tell one way or another. Furthermore, the fund only has a 0.35% expense fee, which is pretty reasonable for active management. Additionally, the portfolio turnover sits at a reasonable 13%, so it doesn't look like the managers are trading too much and creating higher costs for investors. But like I said, JEPI's stock holdings only pay a small fraction of its dividend yield, and on their own, would not provide investors with anywhere near an 8% annual dividend. How can we tell? If we look at their semi-annual report, which covers the last 6 months of 2020, we can see that they paid out nearly $6 million in dividend distributions to their investors. However, during this period, they only earned $840,000 in dividend income from the fund's holdings, or about 1/7 of the money paid out in dividends. This means if the fund was relying on their stock holdings alone to pay dividends, investors would only get a 1 to 2% yield. Fortunately, the ELN component of this ETF picks up some major slack to fund dividend distributions. And before we get into this, I want to reiterate that ELNs are a fairly complicated investment instrument, and they can be structured in a lot of different ways. Plus, even though JEPI markets itself to be a transparent fund, there's actually a rule surrounding ELNs that they don't have to be registered as individual securities. So most of JEPI's ELN activity is happening behind the scenes, and we're left connecting the dots to figure out exactly how they're being used. In any case, we'll start by breaking down ELNs generally, and then we'll get more specific to understand how JEPI uses them. So an ELN, which again is an equity-linked note, is somewhat of a blend between fixed income investments and traditional stock investments. So first, let's imagine a fixed income investment like a government bond. These conservative investments involve lending your money at a fixed interest rate. So let's say you invest $100 in a government bond with a 3% interest rate that matures in 5 years. For the next 5 years, you'll collect $3 in interest every year. Once the bond reaches maturity, you'll be paid back your initial $100 of principal. With this investment, you've collected a fixed income with minimal risk, knowing that you'll receive your initial $100 back when the bond reaches maturity. This is a preferable investment for low-risk investors because it's predictable and practically eliminates the risk of losing your money. An ELN works much like a bond or other fixed income investments with 2 key differences. First, the money lent to invest in an ELN is going to be invested in stocks, hence the equity-linked note. This may be into a single stock, a basket of stocks, or even an index like the S&P 500. Some even go beyond simple equity exposure and also use options within the ELNs to provide more upside potential. And in most cases, ELN issuers will provide 100% principal protection, just like you would expect from common fixed income investments. In other words, ELNs usually guarantee that you will not lose any of the principal you invested, eliminating any downside risk for the investor. The second difference is that unlike fixed income investments, you will not earn any regular or fixed interest payments. This is because the interest you receive is now linked to the performance of the underlying assets. Again, hence the equity-linked note. Whereas fixed income investments will tell you the expected interest rate beforehand, like our 3% bond interest rate for example, ELNs will define what is known as the participation rate. The participation rate describes the percentage of the returns you'll receive if the underlying assets appreciate. So here's a quick example of how that might work. Let's say you invest $100 into an ELN that is linked to the S&P 500. By the time the ELN reaches maturity, the S&P 500 has appreciated 10%, so your $100 investment is now worth $110. While you're guaranteed your initial $100 investment back, the participation rate will determine how much of those extra $10 in capital gains you actually get. If your ELN has a 50% participation rate, for example, you'll only get 50% of the returns beyond your principal. In this case, you would get $5. If your ELN had a 100% participation rate, you would get to keep the full $10 in gains. So overall, ELNs are a useful tool that enable risk-averse investors to benefit from equity gains without risking huge losses. Hopefully that'll make sense because now we're going to put it into context with how JEPI uses ELNs. According to the prospectus documents, the ELNs used by the JEPI fund combine exposure to the S&P 500 with written call options, otherwise known as covered calls. Covered calls are a basic option strategy that produces cash flow when you own the underlying investment, but it caps your potential returns from growth. I've covered it pretty extensively in my videos on Q-Yield and NUSI, so check out either of those videos if you need more information. As explained in a press release via Nasdaq.com, these ELNs allow them to sell covered calls on the S&P 500 every week and generate income, without risking the principal invested. In comparison, funds like Q-Yield and NUSI sell covered calls every month, albeit both on the Nasdaq 100 index. I think this is the first indication as to how JEPI can earn such a large portion of their investment income from ELNs, and we can get a better idea of things by looking at their quarterly reports. This report shows their ELN holdings as of March 31st, 2021, which represented 16% of the portfolio at the time. I want to point out a few particular things here. First, they're all from different issuers. I imagine this is to minimize the risk of one of them going bankrupt and defaulting on the note, as the principal would no longer be guaranteed in that scenario. Next, they all have about a 50% participation rate. Since covered calls limit potential gains on the underlying index, we wouldn't expect to see too much price appreciation on the S&P 500 holdings. But this participation rate shows that JEPI will get approximately 50% of the cash from selling those covered calls, as that would be cash beyond the invested principal. Next, we can see that all of the expiration dates fall about 1 week apart. It's likely that they're holding each of these ELNs to maturity and simply cycling through with new ELNs each time one matures. This is how they're able to sell covered calls every week, and it's cool to see that they're using a consistent amount of cash for each one. However, this is just about all the info we get on the ELNs. JEPI does have a brief page on their website with some vague details about the ELNs they currently hold, but there's nothing there that you can use to dig deeper. So what we do know is that the ELNs are short-term in duration, linked to the S&P 500, and have about a 50% participation rate, but the rest is left unclear. We're left assuming whether there's a 100% principal guarantee, and we know absolutely nothing about the actual covered call strategy within the ELNs. I can only assume that they're selling at-the-money call options because that would produce the highest premiums. But whatever is happening within these ELNs, it must be pretty effective, because if we look at the semi-annual report, they earned just over $5 million in investment income off of about $26 million in ELNs. That's approximately a 20% yield over 6 months, which would be 40% annually. I would be shocked if this all came from covered calls on the S&P 500, when Q-Yield does the exact same thing on the more volatile NASDAQ 100 index and barely yields 12%. Furthermore, if there's no downside risk and these ELNs are so effective, why not use them more heavily and generate substantially more income for investors? At this point, I'm just thinking out loud because I honestly don't know the answer to these questions. I don't want to pretend like I have all the answers here because I'm still a little puzzled by how these numbers are adding up. I just wanted to present how I'm interpreting this information, and I welcome any conversation about it in the comments. In any case, we can still make an informed analysis about the JEPI dividends based on what we know so far, especially knowing where their dividends come from. If we take a look at their dividend history, we can see that the dividend amount varies quite a bit. This chart from Seeking Alpha makes it pretty easy to visualize. And this variability comes from both aspects of their portfolio. First, their stock portfolio is not going to pay consistent dividends every month. Most of the stocks in their portfolio are going to pay quarterly dividends, and likely on different schedules. So this is going to affect the regularity of dividends from month to month. The consistency and ability to pay monthly dividends is bolstered with the ELN component of the portfolio, but this will be slightly irregular too. The premiums from covered calls will be higher in times of volatility, meaning that the ELN holdings will produce lower dividends in a less volatile environment. As we can see by the VIX, or volatility index, volatility has been on a steady decline over the last year. Although JEPI will benefit from these spikes in volatility with their weekly covered call strategy, the gradual reduction in volatility does explain some of the reduction in dividend yield as of late. Ultimately, changes in volatility will affect the consistency of cash coming from ELNs, and therefore the dividends that investors receive. I think this is both a pro and a con for the fund, depending on the type of investor you are. For investors who want to use this fund for income, it may be disappointing to know that you won't receive a consistent dividend distribution every month. Specifically, if you plan on using these distributions to pay for bills and expenses, you may need to leave a little wiggle room when estimating your costs and dividend income each month. But if you're simply using this as a long-term dividend strategy, I think it's actually attractive that JEPI isn't locking themselves into a specific distribution rate. When funds try to achieve a specific distribution rate every month, there's always the risk that their portfolio doesn't produce high enough returns to deliver that distribution. In these scenarios, funds will often issue a return of capital to fulfill that distribution, which over time can drain the fund's NAV and actually hurt your investment. And this is something we've seen with Q-Yield over the last few years. JEPI just recently completed their first full year in existence, and they've yet to publish their annual report. And until that report is released, we won't know the full breakdown of their dividend distributions and whether they've been using any return of capital. For now, since they haven't locked themselves into a specific distribution rate, I imagine they're just passing through their monthly income directly to investors. This could mean more inconsistencies in the dividend value, but it should protect the fund's value over the long term since it won't require any return of capital. As investors, we just need to understand that there will be some variability in the dividends as a result. Overall, with the large cap stock holdings and the regular use of covered call ELNs, I'd say the dividend from JEPI is pretty safe. As we said, there will be some variability in the value of those dividend payments, but the strategy itself seems pretty reliable. I have one more note on the dividends though, and that's taxes, because the use of ELNs comes at a pretty significant cost to investors. Again, JEPI investment income comes from two sources, dividend stocks and these ELNs. These dividend stocks are likely distributing qualified dividends, which means that any of that dividend income that is being passed along to you will also be considered qualified dividend income and falls under the favorable long-term capital gains tax rate. However, investment income from ELNs is not considered to be qualified dividends, or even a dividend at all. Because ELNs are debt instruments, the returns earned from them are technically considered interest. Unfortunately, interest is taxed as income, and when JEPI distributes its ELN earnings to you, you'll owe income tax on it based on your income tax bracket, unless you hold your shares in a tax-sheltered account. Considering that the majority of JEPI's investment income comes from these ELNs, most of the dividends you receive are likely going to be taxed at this higher tax rate. Again, we don't have confirmation on this just yet because the annual report has not yet been published, which would include the breakdown of the dividends. So if you're interested in investing in JEPI, I would suggest keeping an eye on the website for the release of this annual report, just like I'll be doing, so we can figure out what to expect from the breakdown of the dividends. So after considering all of this, should we invest in JEPI? To answer this, I want to revisit the fund's goals, which are to deliver a majority of the returns of the S&P 500, provide monthly income, and reduce volatility. With its stock and ELN strategy, I think JEPI delivers on these goals. So far, it has tracked the S&P 500 pretty well using SPY as a comparison. As would be expected with this strategy, you miss out on some growth in exchange for a smoother ride along the way. But it has clearly managed to deliver some of the growth of the S&P 500 while also paying out monthly dividends. Furthermore, thanks to their stock selection and the use of ELNs, JEPI should be pretty well hedged against the downside to protect investors' capital amidst volatility. In the end, this is probably one of my favorite dividend income funds that I've looked at so far. Thanks to the stock portfolio, it doesn't completely sacrifice growth like Q yield. And thanks to the ELNs, it has some downside protection and added yield without the added cost of multi-part option strategies like those used in NUSI. So if I was seeking a safe dividend income investment, this makes the cut for me. Of course, if you've been following my channel, you'll know I'm more focused on growth and total returns at this stage in my career. So I won't personally be starting a position in JEPI for at least a few years. I hope this video has helped you understand JEPI and its strategy. And if you have any questions or thoughts, feel free to drop them in the comments. By the way, if you're interested in free stocks or cash, check the links in the description for some awesome promotions at Webull and M1 Finance that'll help you kickstart your investing. Thanks for watching, and I'll see you in next week's video.